Well, stocks rallied last week with the S&P 500 notching its best weekly gain since last November, while treasuries firmed amid a rush to lock in yield ahead of the first Fed rate cut this week. Meanwhile, the dollar traded broadly flat as gold pushed on to fresh record highs in the spot market. A jam-packed week now awaits market participants, with the Fed meeting on Wednesday the main highlight, but plenty of other policy decisions are due as well, including those from the Bank of England and the Bank of Japan, along with a busy data docket as well, including the latest US retail sales and UK CPI figures. Plenty to discuss on the trade-off this week. Without further ado, let's get into the show. So only 2 attempts to get the introduction right this week. Not too bad by my standards, but I am a very happy bunny nonetheless this Monday afternoon because North London is red and Arsenal are on the charge. To get his views on that and all things going on in the financial markets, let's bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, very good afternoon to you. How are you doing on this fine Monday afternoon?
I'm okay, mate. Good to see you chirping after just one win. And, okay, it was a big one for you, so I'll give you that. So you can enjoy mugging off all the Spuds fans for a while. Well, until we play you, that is, in a month or so time or a few weeks' time. And then we'll see.
Oh, is it?
Yeah, then we'll see whose shoes on the other foot. Yeah, it's a par-5 kickoff for that one, so it's going to be a bit spicy.
I was going to say, that's never a good thing, a London derby at 5:30 on a Saturday afternoon. But I wonder, what do you think is more likely, Ryan, the Fed to cut 50 basis points this week or Spurs to win a trophy like Ange Postecoglou has guaranteed they're going to?
I think the Fed doing 100 is more likely than that. But you're doing your best to alienate some of our viewers as well again, aren't you? So you'll be getting more letters in the complaint about that one. But yeah, no, they're going to win nothing again. I can always say that.
Indeed. I think that's a very, very safe bet for sure. Anyway, let's get into Topical Thunder and talk about that Fed meeting in a little bit more detail. So all jokes about Spurs and their fans aside, we do have the Fed meeting on Wednesday evening. Powell Co on the FOMC stepping up with, by far and away, this week's main event. And of course, there is plenty of consternation in the market to kick off the new trading week as to whether they're going to deliver a 25 basis point cut or whether they're going to deliver a 50 basis point cut. And in fact, while my base case is for a 25 basis point move and the sell side consensus favors the same, market pricing is starting to tilt a little bit more dovish. And actually, just before we stepped in to record this video, the OIS curve is now pricing a greater likelihood of a 50 basis point move than it is of a 25 basis point move, although that pricing is still pretty much a coin flip. And as a result of that, I think we should all be on alert for potentially some sources stories in advance of that Fed decision on Wednesday, because I can't imagine policymakers are particularly comfortable with things being so delicately poised just, 48 hours before potentially one of the most important decisions of this cycle is announced on Wednesday evening, London time. In terms of the guidance that goes along with that cut, I think it will be relatively non-committal. The Fed will say that risks to their dual mandate are now pretty much in balance. And of course, that dual mandate includes price stability and maximum employment. And of course, the labour market has been softening a little bit of late. But I think the Fed will flag that they'll continue to take a very meeting by meeting approach akin to what the ECB, the Bank of England and most other G10 central banks are doing. Of course, we get the latest dot plot as well. I think the dots will probably show 75 basis points worth of easing this year and another 100 basis points in 2025, which will get rates pretty much back to neutral by the tail end of next year. And I think that's really the question that market participants should be asking themselves. In all honesty, I don't think whether the Fed do 25 or they do 50 on Wednesday actually matters particularly much. I think what really matters is what approach do the Fed take in returning rates to neutral. If we say that neutral is sat at 3%, there's really 2 options the Fed have to get there. They can either say, right, we're going to hurry up and get on with it and deliver 50 basis point cuts or perhaps even larger at a relatively rapid clip and get back to neutral by next summer. On the other hand, they could plot a more patient course akin to what the BOE are doing, where they cut, or even the ECB, where they cut by 0.25% once a quarter. Now, the fundamental thing that we've got to think about is the Fed have 200 basis points of room to cut, 200 basis points worth of cuts that they want and need to deliver. And I think markets are getting hung up on the wrong thing. It doesn't matter what they do this week, it matters what they do after that and how quickly they chew through that 200 basis points, because the quicker they do so, the more out of line they're likely to be with their G10 peers, and thus the more headwinds the dollar could end up facing.
Yeah, we've set that all out nicely, mate, and I'm not disagreeing too much with you. I think, yeah, the 25-50 pip argument, that's going to be good for short-term volatility. My base case is they still go 25, but I do think if they go 25, it's going to be a dovish move, and we're probably going to see a series of rate cuts where they potentially go at every meeting, probably into the new year, maybe lop off 100, 125 pipper cuts, get into the new year, and then maybe take a pause and see where things are. Obviously, it's all caveated by the data. If NFP next month falls off a cliff and only go 25 this month, the market's going to go screaming for a 50 next month. If they go 50 this time around, then the market's going to be saying, well, what do they know that we don't? And then it's still going to be uber dovish going forward. So they're between a rock and a hard place, as always, and as most central banks are. So I think either way they can't win. They can't rule out a 50 because they need to keep that optionality on the table. As we've spoken about in the hike cycle, financial conditions are important. It was important that they tighten financial conditions on the way up. It's going to be the same on the way down, that keeping a 50 on the table loosens financial conditions, so it does half the job for them without them potentially having to do that big cut. So it's all swings and roundabouts. What you say is true. We're going to have to know what the forward guidance is like, whether it's hawkish, whether it's dovish, and then take it from there.
Yeah, absolutely. I mean, the range of possibilities over the Fed is incredibly vast. You've got anything from a hawkish 25 basis point cut to an uber dovish 50 basis point cut, and pretty much every conceivable scenario that you could imagine in between those. So I think it's another case where risk management is absolutely pivotal. Just looking at some of the implied vols in the FX world about over the week, of course, and there's a lot else going on this week, but over the week, I think the market, to one standard deviation of confidence, looking for about a big figure range in cable, a big figure in the euro, and even 3 big figures in dollar yen, which leads us nicely on to your subject, which is the Bank of Japan.
Yeah, well, 3 big figures might be the low end of expectations for this one. And
hang on. I forgot my question. Are you getting up early for the BOJ on Friday morning?
No.
Right, there we go. That's the trade-off barometer of whether the BOJ is important or not. Does Ryan get up in time for it?
Yeah, that's the importance indicator, whether I'm tucked up in bed or getting up for it. But the reason I'm not getting up for it is there really is little expectation for a rate hike at this meeting, which puts the price risk on a surprise hike from the BOJ. I think there's little chance they do it, but one thing that struck me last week were comments from one of the main hawks, Naoki Tamura. Aside from saying that Japan's neutral rate is likely around 1% as a minimum, he also raised some valid points that maybe the BOJ have been a bit too cautious in their approach to hikes and forward guidance so far. For one thing, he said that if the bank followed the market's view on the pace of hikes, i.e. pretty slow, that could bring increased inflation risk. He also added that, too much priority on market stability through their monetary policy may impede that policy. So there is a situation here maybe where they are taking a bit too much of a cautious approach. Now, we all acknowledge that the BOJ need to get this right. Hike too fast and too much, and they risk undoing the fragile economy and inflation gains. But if they go too slow, they may end up missing their opportunity to finally return monetary policy to some semblance of normality. So my view of this week's meeting is to see if indeed they do see things going too slowly and cautiously, which may bring UEDA to change to an even more hawkish position than he's been at recently. That may not mean a nod to a hike soon, but it may be more to a faster pace than we expect now. And if that happens, then the end's going to see some further strength, obviously mixing up in what's happened with the Fed at that time.
Yeah, of course, and dollar yen comes into the week having dipped below the 140 figure for the first time since the middle of last year, albeit, of course, in holiday-thinned conditions as Japan take yet another day off for yet another public holiday. I think the BOJ is interesting. One other thing that did come out last week were these sources stories via Bloomberg. Of course, after the BOJ decision in back end of July, early August, we had this bout of market turmoil, the carry trade unwinding, etc., etc., etc. BOJ officials have said not to view that as any sort of factor that materially changes their economic outlook. So you need to sort of put that jigsaw piece together with policymakers saying, if the outlook evolves as we expect, we'll hike again. Well, the outlook does appear to be evolving as they expected. So I think the market only has about 8 or 9 basis points worth of tightening in the curve by December, which to me seems a little bit underdone, even if they're probably not going to go this week on Friday morning UK time.
Yeah, I tend to agree with that. And we've got a meeting in October, so they could get over this one, see what the Fed does before making a decision. We also get the updated forecasts from the October meeting, so that could be the prerequisite they need to, act then. So I think they're probably hike before the end of the year, data all being well.
Yes, I would agree with that. We're very much a consensus on this show this week. I'm not sure I like that, but I'm sure when we get onto the BOE, as we will now, that will change, because they are, of course, the central bank that everyone loves to hate. Well, the other central bank everyone loves to hate, because obviously we had to endure the tedium of the ECB last week. And it must be said that if you want to trade over the ECB, long tanning salons is probably the best bet, given what Lagarde was looking like and given the lack of volatility that we saw in the euro. In any case, on Threadneedle Street, just down the road from me, what are we expecting this week? Not a lot, to be completely honest with you. August was, of course, a very interesting BOE meeting. We did get the first 25 basis point cut of the cycle, and it was forced through by the narrowest of margins, just a 5-4 vote among MPC members. This time around, things should be considerably simpler. It's almost certain that the MPC vote in favour of holding rates steady. They set a relatively high bar for further rate cuts at the August meeting, saying that they would be taking a meeting-by-meeting approach, but that they were also remaining very, very closely focused on signs of inflation persistence. And with services CPI, yes, it's coming lower, but it's still around 5%. I think it's tough to justify, particularly for those 4 who weren't even in favour of a cut last time around. It's tough to justify delivering back-to-back cuts. The market prices about a 1 in 4 chance that, a 1 in 5 chance even, that the BOE cut rates on Thursday. We do, of course, though, have the latest CPI figures due just a day before the BOE announcement, so we could see a little bit of vol in the pound over that data, but I don't think it's going to materially change things for the old lady on Threadneedle Street. Naturally, the vote this time around is likely to be much more straightforward as well. My base case is for an 8-1 vote in favour of bank rate remaining unchanged, with uber dovish external member Dingra voting in favour of a cut. But it is possible that it's 7-2, with Dave Ramsden, the deputy governor, and of course new MPC member Alan Taylor, both somewhat of a wild card, although the latter would usually be expected to vote with the consensus at his first meeting. The statement should pretty much be a copy and paste of what we saw after the prior decision. The other area of focus, of course, is going to be quantitative tightening. The BOE running down their balance sheet currently at a pace of about £100 billion a year, and about half of that is being done through active gilt sales, which of course no other central bank is engaging in. 2 schools of thought around this. Firstly, you could say that the BOE should slow the pace of quantitative tightening, given that firstly, the balance sheet is actually tightening conditions while you're trying to loosen conditions by lowering bank rate. So, the left hand not talking to the right, so to speak. And the second thing is that there is a little bit of a funding squeeze going on in the UK financial system at the moment. We see short-term repo usage hitting a record high pretty much every week, and repo rates ticking higher as well. On the other hand, you could say that the BOE should actually quicken the pace of quantitative tightening, because next year has a remarkably large amount of gilt gilts being matured, and as a result of that, if you kept the pace unchanged, gilt sales would drop from 50 billion to about 15 billion, which some would say is an unnecessary decline. What the BOE do on that front, I'm not entirely sure. It should cause some vol in the gilt market. Not sure it's a major story for the pound. But what is a major story for the pound is that I think the BOE will again stress this kind of cautious path they're taking to remove restriction from the economy, which, all things being equal, and of course depending on what the Fed say on Wednesday, could provide a little bit of support to cable over the medium term.
Yeah, I think this meeting's going to be a bit of a can kick. We've obviously got, we've also got the October budget coming up, and I think they're going to want to see what comes from that.
Oh.
It's important. Got to remind you of that one. So I think that they're going to want to see what comes from that. Again, the next meeting, I don't think we've got a meeting in October, so it'll be November. I think the next meeting is, if I'm correct. And
it is. And actually, sorry to interrupt you on that one. You're right to mention the budget, even though we don't really want to. The budget is the 30th of October. The next MPC meeting is the 7th of November. So by my very rudimentary understanding of BOE process, they wouldn't actually be able to include any of the budgetary measures in their monetary policy report forecasts in November, because they would come too late for them to be included in their economic assessment.
That's assuming they don't get them in advance, which we know that the Treasury will have them, and there'll be discussion. So I think they'll know.
The newspapers get them in advance, to be fair.
Yeah, of course. So I think they will know exactly what's coming from the budget. Doesn't mean they're going to act upon it, but they just like to know what they're going to be doing with the balance sheet, for one thing, and how much the government's going to dig themselves out of this 22 billion black hole that's supposedly floating around somewhere. But that's another situation altogether. The votes are going to be important. They always are. They're the indication of how likely a rate cut is coming. The votes could be, if it's closer, more to a 6-3, 5-4 in favour of unchanged, then that just gives the market a little bit of a nudge that they're closer to a cut than a vote of 8-1, for example. So that's going to be where we get the main thing from. The balance sheet stuff, I don't know. It's one for the propeller heads like you, mate. So I'll leave that to you.
One for what? The propeller heads?
Yeah, that's what we call them. That's what we call them. The people who like getting stuck into all the nitty gritties, the third decimals on CPI and everything like that.
Oh, I see. Oh, right, fair enough. I'd have called him a geek or a nerd, but I guess propeller head works. Anyway, moving on. You mentioned the BOE. You mentioned the fiscal outlook here in the UK. You mentioned the budget. One thing we don't have here is economic growth, or at least we're doing our best to shoot ourselves in the foot and get rid of growth that we do have.
Yeah, much the same as a lot of countries. So yeah, it's the growth train I want to talk about here, and this is one thing that seems to be linking a lot of the market moves at the moment. Is worries over a global slowdown. The last couple of weeks have shown that fear growing. It seems the market is finally getting the Fed cut and has added to those worries as well. It's as if Powell admission on cutting rates and cutting on the back of slowing jobs has been the icing on the cake for sort of growth bears. Because if the US is finally admitting they're worried about a slowdown, then the world is going to slow down too, which in reality is usually what happens. So that's a thing that the market's been getting into. Now, we know countries like China are still on the back foot, while growth remains anemic in Europe and the UK and elsewhere. So growth bears are coming out of the woodwork, and that's adding to the market doves surrounding central banks. So we're in a place where the calls for bigger and faster cuts are growing, which are going to be something the central banks are going to likely need to push back against at some point. So trading this for the foreseeable future is going to be about knowing whether the market pricing is getting too extreme versus what the central bank is doing, or whether that extremism is justified or not based on what the data is saying and doing. So on the trade-off a couple of weeks ago, I topicked that we would be seeing volatility pick up in September and for the rest of the year into 2025. And so far, September hasn't disappointed, and in a big part due to this growth issue that the market's seemingly putting the putting the thread on. So I think we need to look out for more of the same going into the end of this year, and particularly into the new year, because there's always new year optimism, and the markets want to see an improvement in economies going in. And if they don't get it, well, then we're going to be playing this dovish game for a while longer.
Yes, indeed. First, a yellow card for this shocking pun that you've got going on there. I can see you're trying to derail this show, but I'm not going to let it happen.
If I'm getting a yellow for that, you're getting a red for that one.
Sorry, mate. I do think your point around marrying up data and central bank expectation is a very important one. I think the other thing is, particularly at the moment, and you see this, I was making this point with our good mutual friend, actually, Ryan Paisley, on a call earlier on this morning. The problem the market has at the moment is twofold. One is that central banks haven't really given any sort of concrete guidance. So we've got this hypersensitivity among market participants to the data that we're receiving. And the second issue is that the data we are receiving is actually quite mixed. I mean, you think about some of the US data recently, the labor market report, headline non-farm payrolls points to job creation slowing. But then on the other hand, unemployment is actually coming down and participation remains pretty high and average hourly earnings are a little bit hot. You look at the CPI data we got out of the US last week. At a headline level on an annual basis, CPI is at its lowest level since February of 2021. Then you look at the core number, we're still north of 3% on an annual basis. And month on month, we actually ticked higher to spot 3 from spot 2. The University of Michigan data we got on Friday, that was the same. The PPI data we got was the same. So it's all a case of, this data, you can actually make a convincing argument for both sides of the policy debate, which certainly isn't helping markets to sort of garner a clear idea and a clear picture of what's going on at the moment.
Yeah, exactly. And the market always looks to the US, the same as it looks to China. There's really only two countries that drive market flows, and that's what's going on in China regarding growth, and that's what's going on in the US regarding growth. And the Fed are heading toward cuts. They're not heading toward cuts because the economy is heating up. They're heading towards cuts because the economy is slowing down. And it doesn't take much for market and growth bears, as I call them, coming out of the woodwork, because the market always likes to be more bearish than it is bullish, and it always goes too far on that side. So we're in this situation. We know how to deal with it. We should know how to deal with it. And as you say, just marry up what the market does, look for those extreme moves against the actual fundamentals or what the central bank's doing. And there's your trading opportunities.
Indeed. Yes. Right. Let's move on to some charts. Right, where are we starting this week? We're starting with gold. We're doing a full cross-asset look this week. Gold, very simple, touching fresh all-time highs last week on Thursday, breaking out of this range that we've been in for 2 or 3 weeks, notching a fresh record high on Friday, and then pushing on to fresh record highs again this morning. And it looks like the yellow metal has simply become a momentum trade once more, almost exactly as we saw in the tail end of Q1 and the middle part of Q2 earlier in the year. There's not necessarily a fundamental catalyst behind the move. We haven't seen any particularly significant flare up in geopolitical tensions. The dollar's pretty flat, sentiment's okay, treasuries have rallied a touch, but nothing too significant. And it seems that just this break of 25.30 has brought in a whole host of fresh buyers, and it does look like a move that it is relatively difficult to step in front of just yet. Obviously, we are in pretty much uncharted territory at the moment, so there are no real defined levels to the upside unless folk want to get out some Elliott waves or their horoscopes or whatever it is they're looking at. I think it really is the psychological round numbers and the big figures that we now need to look at least in the short term, as levels to watch the upside, and 2600 naturally presents itself. To the downside, key support is the top of that previous range at 2530. If that does indeed hold on a retest, then I think it's easy to have a lot more conviction in some of the upside that we've seen, despite the yellow metal being a little bit attached from its fundamentals. But it does remind me, Ryan, of a phrase that we used to use quite often towards the start of the year, in that the trend is your friend, and so it would seem with gold at the moment.
Yeah, very much so. It's taken a while before it's broken out this range. And one thing I was looking for around the NFP week when we had all the data is whether we would get a move in gold that would break this level. And I wouldn't have been that keen on that sort of break if it came around a data point, because you can get a quick fake out on a data move and it comes back into the range. So this break-in last week was very significant. I was watching it all the way through. I was trying to trade it. I made a complete hash of the break trade. I flipped myself out when we broke briefly to 34s and then came back under again. So messed that up, and I've watched it sail into the sunset, another 50 odd bucks above. But for now, traders who are looking at this one need to be careful. If you're not long and riding this one, you're probably turning the other way and looking at where the top's going to come in and potentially looking to short it. So for the next few sessions, few days, we probably need to see where exactly the resistance levels are going to show up, where exactly the solid support levels are going to show up. We've got one around 25.63-ish that confirmed sort of on Friday, and that's probably just around where the tops and lows of those candles you've got, those last two candles are. So we've got a bit of development, but chasing a top when you've had a market sitting at a level for weeks and then making a big break is not something you want to be doing. Buying the dips, but pick your points. So where this goes from now, 2600 is the big target, as you say.
It is indeed. Right, moving on, treasuries.
Treasuries indeed, and going back to look at the 2-year yields, and I shared this setup 2 weeks ago, and that was when these yields were trading up around the 390s, 4% mark, and I said we could probably get down to the 350 area, and we're currently trading at 355, so things have gone according to plan. The question now is how much further can we go, and the reason this is important is because it's really been these moves in bonds that have driven a lot of other assets, particularly the yen, over the last few weeks. So again, if we work on the basis that the Fed may see a neutral rate somewhere around 3%, I would expect 2-year yields to continue coming down. Now, it's unlikely we're going to go in a straight line, so I'm expecting yields to maybe just hover around 3.4, 3.5% mark for a while. That's if the Fed isn't uber dovish this week. And a move lower than that after would likely be driven by subsequent week data or as we play the 25, 50 pip cut games through to the next FOMC. Now, however, given the size of flow so far, there will be a time where the market is done piling into bonds and locking in yield, as Michael mentioned earlier. So the lower yields go, then the less value there's going to become in the trade. And obviously, as we get closer to that Fed potential neutral target. Now, if we get a pause in these moves, expect the dollar, more so the yen, to also see a pause and some consolidation. So these moves, as I mentioned 2 weeks ago, they're coming on the back of locking in yield. They're coming on the back of the market, keeping yields a little bit high, not representative of where the Fed cuts are likely to go. And now we've seen that snowball really picking up the pace. So there may be a little bit more to go, but then I expect us to sort of hit a bit of a level.
Yeah, I think I agree with pretty much everything you said there. I'm not sure I like this feeling, but it's where we are. It is definitely a case, I think, that the moves that we've seen, particularly at the front end of the curve, of people just rushing to lock in yield. The 3-year auction we had last week, we saw that have record indirect demand, which again is a bit of evidence towards that. The 10-year auction last week, that stopped through the when issued by 1.4 basis points, which is pretty chunky. But to your point, 30-year yields dipping back under 4%, and that auction tailed by 1.4 basis points. So auctions are not a sort of foolproof way of gauging demand for treasuries, but they are a useful way of doing so. And it does just speak to your point where, this sort of hunt for yield only takes you so far, and it will get to a point where investors say, actually, maybe we're having second thoughts at this stage. And when it does, expect a few ripples, not just across the FX space, but into perhaps precious metals as well, as we were just touching on with gold.
Yeah, exactly that. And I think the Fed this week is going to be a big crunch moment for a lot of assets, as we know. So I think another one where I like to see where prices are at the end of the week before making a true decision.
Is there a Fed meeting this week? No one's mentioned it.
Sorry?
Is there a Fed meeting this week?
I don't know. Is there? I'll have to check my calendar.
Oh, I don't know. There's been hardly any mention of it on this show or in the media or anything. I mean, Wouldn't have guessed. Anyway, moving on, away from the Fed for a second, WTI crude. I wanted to take a brief look at this this week. We did see crude, both Brent and WTI, recover a little bit of ground last week. Of course, that comes off what was a dismal week the week before, about a 9% decline in both blends of crude, and WTI trading to its lowest levels since the middle of 2023. It must be said that the move we saw last week did feel a bit sort of dead cattish, for want of a better word, rather than any sort of sustainable move higher. And of course, we did test this $70 a barrel handle on 2 occasions and failed to break through it on both of those tests, which again just implies that the rally perhaps isn't as sustainable as the bulls would like to see. And of course, the demand outlook remains pretty dour as well. And we had some further dismal Chinese data, particularly industrial production data, over the weekend, which certainly won't help the bulls' case. Of course, the other thing to bear in mind is that the market continues to view both geopolitical events and weather-related news flow. Of course, we had a hurricane in the Gulf of Mexico last week, as very much buy the rumor, sell the fact trades. And I think that is very much the view that I continue to take with crude. I think fading into this $70 a barrel handle is something I would be looking to do, barring a significant improvement in some of the industrial data that we're seeing. The prior lows that we saw a fortnight ago come in around $65 a barrel. And then, of course, you've got this massive $64 a barrel from March and May 2023, just below that, which is absolutely pivotal from a technical point of view if the bears are looking for a further level below.
Yeah, well, talking about growth, and this is one of the ultimate growth assets to look at. We can see, and we've been saying it for quite a while, oil markets have been dropping, oil price has been dropping because the demand side, manufacturing side of things is really in a bit of a slump. So the only time we really get a rally is if there's something kicking off in the Middle East, which is always a headline away. Now, it's funny, you always know when the market, or when at least the experts don't have a clue, when you see headlines like oil has rallied and this bounce has come about because the Fed are looking to cut by 50 basis points. And then you see another headline that gold has rallied because the Fed is looking to cut 50 basis points. So everyone's tying every price move at the moment to what the Fed's doing. I don't believe any of it really, but it speaks for itself. The bounce looks pretty weak, as you say. And if we have another test down towards those 65 lows and we don't hold, then maybe we're going even lower, 60s, 55s, who knows?
Yeah, indeed. It is a pretty grim chart. Right, I'll give you a challenge then, Ryan. You're bemoaning everyone talking about the Fed. Can you get through this 2 minutes on dollar yen without mentioning Powell Co?
No.
I didn't even try. I'm disappointed in you.
Yes, well, okay. You can beep it out then if you want when you do the editing of the show. So, yeah, I'm going to look at dollar yen because it's tied into yields. It's tied into beep over in the US. So now I'll put my own ones in. There you go. So yeah, we have to also remember that there is the Japanese side of things too, and the fact that the yen has been a huge funding currency for those carry trades. Now, the reality is that assuming that the Fed go for a 25 pip cut and the BOJ stay unchanged, the divergence between the Fed and the Bank of Japan will have closed by only 60 basis points thus far this year, which still leaves a healthy 4.8, 4.9% differential. And that's still a big differential for some of the carry traders and some of the carry currencies like the Mexican peso, which still has a 10.75 interest rate. Now, on paper, there's still plenty of returns on offer for carry trades. However, when a herd starts moving, it's very hard to stop. And that's what we're seeing in dollar yen, which seems to be printing a new low big figure every time I sit down in the morning. Now, on the tech front, we have some longer term fibs in situ around the 139, 140 area. We've already done the 140 fib. And depending on when this show airs, we may have cleaned out the 139 as well. But until that time, we've still got a fib down here, 139.27, I think it is. Below that, we have a big level at 138, which is quite a historical support and resistance area when we had this move up. Now, volatility is still very high. We're still trading up around 12, 13% in the 1 month vols. So one still needs to be cautious trading this and quick to take any partial or full profits when seen. And I think we only start calming down as mentioned, once US yields maybe find a bit of a base and the Bank of Japan picture becomes clearer. So for now, I'm only trading this as a counter trade to any Fed 50 basis point extremism, or when I have defined support or resistance levels that last longer than the proverbial 5 minutes.
Yeah, good luck with that one. I think 5 minutes is a long time in dollar yen at the moment. I think the momentum certainly favors further downside. But again, I think this, just in general this week, it feels like one where, particularly with something like dollar yen, you look at your chart there, we've come from 162 effectively about 4 or 5 weeks ago to 139. If you've been short dollar yen for even a decent chunk of that move, you got in at 145, let's say, it feels like the sort of week where you'd perhaps want to take some of that risk, if not all of that risk, off the table, and then reassess once we've heard from Powell, once we've heard from UEDA, maybe even once we've heard from Governor Bailey down the road on Threadneedle Street as well, just given the amount of moving parts that we've got over the next 3 or 4 trading days.
Yeah, I think this one is a big risk of a volatile move. Obviously, if the Fed are dovish and more dovish than expected, then we're going to be heading much lower. But conversely, if the market's disappointed, then this could spring back 144, 145. It really could see a really big snapback. Of course, we'll probably get the rally sellers coming back in, because if the market's not very dovish this month, it'll get all dovish again for the next FOMC. So we'll play the same game over and over. The trade's not for turning just yet, but you may get a decent bounce to get into.
Absolutely. Of course, before the November Fed, we have that thing that we're not allowed to mention on this show, which is the US election, but we can deal with that nearer the time. In the meantime, let's get on to our plays of the day. Right, equities for me this week, 25 or 50 basis points. I don't think it really matters to the S&P 500, to be completely honest with you. The trend is your friend here as well, and we're back north of both the 100 and the 50-day moving averages. And I think market participants are still safe in the knowledge that the Fed are able to do more, and quite a lot more, if they see the need. Of course, we're about 200 basis points above neutral, and if you want to go there, we're 500 basis points above the zero lower bound. And of course, you can tinker with the balance sheet as well, and I think that's giving the bulls plenty of confidence to remain further out on the risk curve. In terms of levels to the upside, you've got the all-time high, of course, at 57.20. You've got this congestion that we saw towards the back end of August, which I haven't marked on the chart, a little bit remiss of me, but that's about 56.80, 56.90, which is perhaps your sort of intermediate resistance to the upside. And of course, the key levels to the downside of the 50 and then the 100-day moving averages in pink and green respectively. But for me, any of those dips, they're still seen as buying opportunities. I think the path of least resistance continues to lead to the upside. And if we get a knee-jerk move lower on the Fed meeting on Wednesday, then that is just good news for the bulls, because it gives another good level to get back in at. Ryan, euro sterling.
Yeah, I'm going with an old favourite pair of mine, euro sterling, and potential opportunity to play the big support down at 8400, 83, 85. This level has confirmed a few times now, and I'm looking at 2 ways potentially to play this one. Firstly, if the dollar's a big mover over the Fed, we're likely to see the usual volatility difference between cable and euro dollar. So that's going to move euro sterling. If that's dollar strength, then cable likely goes down faster than the euro. So we'll see euro sterling getting a bit of a bid on, and vice versa on dollar weakness. Secondly, we then have the BOE, who could be a coin toss over whether they're dovish or not. So that's another way to play this one. Any which way, I'm looking for a long into that 84 big figure, either on a test and hold or on a weekly close above if we've dipped below during the week. So longs on this one against the big support.
Good stuff. Thank you very much, mate. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Square Live and Forex Analytics for joining me. Thank you also to our stand-in producer this week, Raf, for bringing the show together as brilliantly as usual. And we congratulate Kyriakos on his new arrival. He will be back with us next week, and that is indeed when we'll be back with another episode of The Trade-Off. In the meantime, wish you a very good week ahead. Hopefully you safely navigate all the event risk landmines that lie ahead this week, and we'll catch up with you this time next week. Thanks as always for watching, and goodbye for now.